All right, thank you guys all for joining us today. Eric Wilkinson with Pro Trader Strategies. This is going to be on the long iron butterfly. It's a great strategy for really low implied volatility. You expect a big move, a pop or a drop. Well, we can take advantage of it with the long iron butterfly. Now, if you guys remember, last session we did it on the straddle. This is on the iron butterfly. One of the differences is this is more of a defined risk strategy, or a defined reward, if you will. It's the other one was defined risk as well, but the difference is this one's going to have slightly better probabilities of success. Why? I'll talk about that here in a minute. I'm going to go into a lot of details around this strategy. So let's get on with it without further ado. But let me get a couple of things out of the way real quick. I'm Eric Wilkinson. You very well may recognize me from mainstream media, where I've talked about the economic data, the geopolitical environments, how that comes in to impact the markets with my market analysis. I've been trading ever since college. Started trading in college with a psychology degree, switched it over to finance when I started falling in love with trading. I actually had some money I had earned from working on farms and stuff like that since I was like 13 years old. And in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products and just about all market conditions. So without all that done, let's talk about the iron butterfly. Actually, let's talk about putting the iron butterfly on the shelf for right now. We're going to kind of forget about this because we don't go into any day where we're just like, hey, I want to put on an iron butterfly today, No, we don't do that. What we do is we come up with a directional assumption, whether it's bullish, bearish, market neutral, or hey, we don't know what's going to happen. We just think it's going to either pop or it's going to drop, which is exactly where this strategy comes into our focus. So what we're going to talk about today are a few things. I'm going to talk about when we come up with our directional assumption, we need to know the destination. What I'm talking about here is the destination is our direction. So we want we need to know if we are bullish or bearish. So that's one of the first things we're going to talk about with this one. We need to know our direction, bullish or bearish. Destination. This has to do with how tight the markets are. And we're going to talk about how tight these markets need to be in the option montage. And when we talk about the option montage, it's basically the option page where you're looking at all the different stuff going on there. Yes, right now you might think that it is like looking at an airplane cockpit. All these like dials are swinging, all the numbers are bouncing back and forth. People used to say that about the floor. It was like surrounded with all kinds of different markets. Well, the bottom line is, and the price is changing everywhere. Bottom line is you just need to know where to look, and we'll streamline that process for you with the looking at that option montage. The environment, we're going to be talking about implied volatility, all right? All right, and the destination or the duration, we need to know what days to expiration we need to be specifically looking at for an underlying. And then the strikes, we're going to be talking about this because this is really important. A lot of times when you go online, they don't talk about specific strike location. And what I'm talking about with strike location, I'm not talking about the pricing aspect of it. I'm talking about deltas. And we're going to really dig into those details. I'm going to show you what is the best strike location, how to build this out for the best risk reward for this strategy. All right, so first off, though, we need to talk about the roadmap key because we are talking about the roadmap to trading options. Well, if we have a roadmap to trading options, we need to know what this roadmap key means. And delta is the effect of the option premium in relation to the underlying. What does that mean? Well, delta, when we're looking at it, is a decimal point, and we're talking about delta over here right now. Now, you can see the delta changes. When the markets get really wide in here, you can see that delta number is off a little bit. It should be closer to 100. As you can see, it incrementally goes higher. Once it goes that deep in the money, it should not go away from 100. But because the market's gotten a little bit wide back there, it's going to do that. All right, so delta. If we're talking about this number right here, it's 45 cents, right? And one thing when we're talking about, I got this brought up last week in an email, and I appreciate you guys reaching out to me on emails. I want to make sure you guys are all clear on concept. Please ask your questions during this webinar because everybody else is probably going to have a similar question that we can answer here. But yes, options are correlated to 100 of the underlying. When I'm talking about 100 of the underlying, that means basically multiply everything by 100 or move the decimal 2 ticks to the right. All right. So 45 cents, $45, give or take. I always talk about it in the way it's given here. But like, for instance, if I went out and bought one contract here for this underlying, yes, it would cost me $375. Okay. I'd probably get better pricing than just buying that offer, but that you get the gist. All right. So 45 cents is what we're talking about. So, and that's because the assumption is you bought 100 of the underlying, and it's trying to correlate that. Yes, you can buy fractional shares, you can buy one share and stuff like that, but the options are equivalent to 100. You can't shave that off. All right, so the bottom line is here, we are talking about delta in relation to the underlying. This is speaking to everything with these Greeks is assuming you're moving forward or moving higher in a sense. So we're talking about moving from 148.35 to 149.35. Okay, so that's $1 increase. Well, then the premiums would increase by the corresponding delta. So these 150 calls, these are the calls on this side. The 150 calls are going to increase by 45 cents. We'd be looking at $4.05 on the bid, and then $4.20 on the offer. That's that first dollar move. Notice over here on the column for the puts, these are our puts over here, right? These are puts, these are the calls. So the puts are negative. Why? Because everything's assuming we're moving higher, right? So if we moved up by $1, these puts are going to decrease by the corresponding delta. So they would go down by 38 cents on that first dollar move. So then we'd be talking about this moving from $3 to, I'm just going to say it moves higher. So $2 and what is that? 62 cents, right? And the offer would be then $2.72. So it decreased by that corresponding amount. Now, think about it this way, where the assumption with all the Greeks is we're moving forward. If we moved down by $1, then a negative dollar plus a positive delta would make that then a negative delta on the call side. And over there on the put side, we're talking about a negative dollar plus a negative delta. That downward move, those deltas become positive to the premium. So it would add in. So if we move down by $1 from where we were at 148 to 147, then we would see our premiums on these 145 puts increase by that 38 cents. All right. So think about that also, basic math, a negative plus a negative is a positive, positive plus a negative is a negative. All right. Pretty simple so far. All right. So gamma, easy. Delta, I want to talk about delta real quick. Delta is data because it's going to talk a lot about probabilities, things like that. The further on we go there. So keep that in the back of your mind. One of the basic things, though, is for every dollar move, the corresponding options on delta move by that increment. What happens on the second dollar move? So if this is dollar number one, we got $1. Now we've got a $2 move. Well, then gamma goes with delta. All right. Gamma goes with delta. The easiest way to remember what is gamma? What's that thing over there that nobody ever talks about? Well, it just goes with gamma. Gamma goes with delta on that second dollar move. And so when we talked about this moving up by 45 cents on the first dollar, now we're at 150.35. So, right, we've moved up $2. Pretty simple so far. Well, now we talked about gamma. Gamma goes with delta on this dollar move, or second dollar move, or on this dollar move, I should say. So 48 cents would then go into the premiums over here. So we would be looking at $4.53 on the bid and $4.68 on the offer. Right? So 48 cents goes into those on the second dollar move. And does this help you out all the time? No, not necessarily. It just gives you that idea that it is continuously adjusting, and you can kind of, look out in time and see what it is. Gamma is probably one of the least of your worries, or the ones that you're not really going to be that concerned about, but it's good to absolutely know this. Again, over here, we're at 150 still, right? Still talking about 150. That second dollar move higher, we've got a negative delta plus a positive gamma. So a negative plus a positive, it comes out of it. So 35 cents would then come out of our premiums on that second dollar move higher. Again, we add that negative component to it, a negative $2 move. Well, then on that second dollar move down, then our premiums would increase by 41 cents, right? They would increase by 38 cents on the first dollar move down, because a negative plus a negative makes that a positive, would turn that into a positive, right? Well, now on the second dollar move down, we have a positive delta plus a positive gamma. So therefore they combine there. All right. Pretty simple. Vice versa over there on the calls, we have the negative move, negative first dollar move. It comes out 45 cents. Second negative dollar move, which makes us down $2 from where we currently are. Then gamma would come out of that delta, right? So only 42 cents on that second dollar move. You with me so far? Pretty simple, right? Easiest way to remember theta, it's the thief. All right? Theta is the thief in the night. Every night, our premiums are going to be impacted by that number being shown. And it's going to adjust every single day. It's going to adjust higher because theta is more aggressive closer to expiration. Think about it this way. You're getting ready to move, or you're getting ready to go on vacation. I don't want to put this fear into you, but you're getting ready to leave or close the doors. Well, theta, he's got to come in and take everything he's got before those doors get locked, or basically there's no more trading in that option. So the closer to expiration, theta, the thief, gets really aggressive. So further out in time, less aggressive. Very close to expiration, like our monthlies right now are getting inside of 15 days to expiration. You'll see, I've got a chart for you, how the theta component really picks up, and it kind of looks like this, and boom, it really starts getting aggressive. That's a little bit extreme, but you get the drift. Theta is the thief in the night that comes and steals our premium. So we look at this column and we can see that theta is always negative. Theta is always negative because you can't go back in time. Remember we talked about this, everything is an advancement moving forward. Well, theta is the same way. It's expected every single day theta is going to come in and eat away at our premiums. More and more aggressive inside of the closer to the expiration we get, but nonetheless, you can see it's always a negative. So tomorrow you would wake up and you would lose 6 cents from, if nothing else changed, and lose 6 cents from these as well. All right, so if nothing else changed, we opened up right here where we were the day before, you would see your premiums come out by the corresponding theta. And again, theta gets more aggressive. I got a better chart to show you how aggressive theta will get as we go forward, but just know that further out in time, theta is more aggressive. All right, Vega, the only one without a true Greek. It's not really a Greek alphabet. But somebody decided to make it a Greek because Vega probably sounds like volatility. And really, that's really what we're talking about is volatility. And I stole the Greek symbol from Gamma. It's the lowercase Greek symbol if anybody's just wants to know a little bit of side trivia there. So we're talking about advancements here again, right? Everything moves higher is the assumption. So this would be assuming Vega is over here, which is just implied volatility. All right, it's implied vol, which is forward looking also. Implied volatility is the expectation of future volatility versus historical volatility is the volatility we've seen. Now, if you guys follow me on like the daily market commentaries or watched me ever talk about like economic data and how that's impacting the overall market, you know that the most important economic data points for me are forward-looking ones. You know, like we just got the Institute for Supply Management, ISM, Institute for Supply Management, ISM, PMI, which is Purchasing Managers Index. That one is one of the best forward-looking economic data points. Tomorrow, we're going to get non-farm payrolls. Well, that's already happened, okay? What does that tell me going forward? What's the outlook going forward? You know, that's behind us already. So I mean, I do look at those economic data points and how that's going to impact the overall markets. Don't get me wrong, but I do like the forward-looking ones, and that's why you'll hear me talk more about implied volatility going forward as the more important volatility indicator. Even more so, I mean, I do look at the VIX, but we need to really look at the specific underlying being XYZ, right? I don't care what the VIX is. I care if I'm trading XYZ, what XYZ's volatility is, all right? So a little bit ahead of myself maybe there, but basically what we're talking about is 27.57, right? We've kind of increased by 1 percentage point, all right? So then if this increased by 1 percentage point, the price has not changed 1 penny, not even a half a penny in this instance. Days haven't gone by. We just uptick by 1 percentage point in the underlying. We would then see our premiums increase on the put side and notice on the call side, they are both positive, right? Because it's the assumption that volatility increases, all of the premiums are going to increase, okay? Flip side, obviously, we go down with volatility. We get a negative 1% volatility. A negative plus a positive is a negative. So if the volatility goes down, then we would see our premiums deflate or go down by the corresponding volatility. Pretty simple, right? Hopefully I've dispelled the guise of the Greeks being something really terrible. You can really glance at them very quickly, see how they're going to affect your premiums, okay? Another caveat, or I don't know if it's a caveat, but another thing with volatility affects further duration options more than the nearer duration option. So the Vega component is going to be greater further out, all right? And volatility has a tendency to creep up and then it just implode, being we get volatility crush. So that's just one of those things with volatility. You see it kind of creep up and then it'll come way off real quickly. I'll show you some charts of that here in a little bit too when we're pulling up. I'm going to drill down into implied volatility here in a minute. All right, so with all of the roadmap behind us, now we're on to, you know, our roadmap key. Now we're on to the roadmap. We're looking at the roadmap of, or the guidelines that we want to follow in order to implement this strategy. So the first thing we come up with is we're looking at an underlying. And for this particular strategy that we put on the shelf and forgotten about, my directional assumption here is what I'm talking about. Where are we going? Are we going bullish or bearish? All right. Well, in this idea, like sometimes, I don't know if you guys have been there, but I have a lot of times where we're at a precipice. You know, you could look at like in this environment with the drug stocks, they're either going to knock it out of the park or they're going to fall flat on their face, right? People have priced in the probabilities that they've got a pretty good chance of, you know, saving us all. But if they do, it's going to pop. And if they don't, they're going to drop, right? So with that, I'm just kind of laying it out for you, how we come up with an assumption, right? Sometimes there's a point in our lives where we're looking at the underlying, we're like, this thing is either going to take off or it's going to fall flat on its face. So it's going to pop or it's going to drop. So that's the idea here. Where are we going? Well, at the end of the day, we're going to either start out here in Indianapolis. Let's just say Indianapolis, and we're going on vacation, maybe fall break for people, and we're going to go either pop or we're going to drop. All right, we know we're not going to Salt Lake City. We're going to Spokane, Washington, or Phoenix or something like that, right? We just know, or we just feel, not that we know because we never really know, we just feel that is out of the question. It's been trending here too long, but we think we're either going to go north or we're going to go south, but which way we aren't going to know until it happens, right? We're kind of shooting from the hip here. So in that regard, neutral, we believe, is out of the question, but we could pop or we could drop. So that's our assumption. We've got two directions. We can't really decide where it's going to go. We don't really want to decide. We just know that something is around the corner that's going to make this market start moving, and it could pop or drop. And that's the same with the S&Ps, right? I mean, you could be looking at stimulus packages and stuff like that. That can make the market pop, and if we don't get it, it can make it drop. So obviously, back to this one again, we're starting out here, and we aren't going to decide until the last minute whether or not we're going to go to point A or point B on that. So we've got our underlying. For me, I'm looking at FDX. Sorry, it's kind of getting blended in there, but I'm going to be looking at FDX, right? I was, to be honest, looking at like Disney because of that whole same scenario. The reason why I chose FDX isn't really because I have a pop or a drop. It just fits everything else. So we're going to use that as an example today. I'll go into those details when I'm pulling that one up. So I picked FedEx in this one. So what we need to decide, is it worth going, well, our destination back here, actually, we're starting out at home. So we're going to FedEx, maybe two places called FedEx, 2 points of interest, sorry. So those points of interest is really what I'm getting at. Is it a good destination? And so, for instance, here we go. I've got my FedEx up. So what we are talking about here is in the option montage, and this is the option montage, all of this stuff. You're looking in the cockpit of a fighter jet right now, and all of this stuff is like, blinging at you. I'm going to take some of the noise out, hopefully. So is it a good destination? What I mean here is there are a lot of volume and open interest, in relation to our roadmap. Are there a lot of things to do at those 2 points of interest, way up there or way down there? Is it worth going there, right? So what we need to discern is there a lot of open interest in the option montage? And the way to do that is simply for a stock that is greater than $100, and I'm just going to write over here, if it's greater than $100 stock, all right, we're just going to move the decimal 3 ticks to the left, all right? So if it is less than or equal to my rule of 3 ticks to the left, moving it 3 ticks to the left, in this case, 25 cents, right? Or over here, you can look at it 1, 2, 3. So 25 cents. So if we got 25 cents, I need to look at the option montage that is closest to expiration. Sorry, over here. Option montage closest to expiration, or I usually say the one that is, like around that 35 days to expiration. Yes, you could say, well, that's probably closer to 35 days to expiration. Well, right now, it could be like flipping a coin. 15 days to expiration is probably still where we're seeing a lot of the volume and open interest for this, at least on a daily basis, volume going on. They are probably rolling out in time to that 50 days to expiration. So we're starting to see that volume pick up out there and the open interest. But for this instance, I want to throw it out to here. We got 25 cents. Does it fit the rule? looking at these option montages. 25 cents to the bid offer here is what I'm talking about. So you can see it is inside less than or equal to 25 cents to the bid offer in the option montage. So we want to look at the ones that are just at the money, just out of the money. That's where we're going to see most of the participation. Why? Because if there's a lot of people that have open interest here, they have a vested interest in keeping an eye on this underlying, right? They definitely want to see what's happening in those options, all right? So they're falling over each other to make the market, free market price discovery, tighten these up. And Havana, I'm going to say Havana because I don't want to butcher it any worse than that. I'm going to call you. Let me, when I get through with this thought, I will read that over and share it with everybody. But just give me 1 second while I have this thought. So stocks over $100, move the decimal 3 ticks to the left. So like we talked about, moving at 3 there. And then you want to look at the days to expiration, when the spot month is what we used to call it. And right now, 15 days is probably still considered the spot month. It's going to start slowly losing that designation here. So we looked at the bid offer, and when I'm saying 25 cents, you can see $8 to $8.20. That's inside of that 25 cents. If it is less than $100 stock, now we're talking about less than $100 stock, it needs to be less than or equal to 10 cents wide. All right. And if we're going with this whole theory of the roadmap thing, roadmap thinking, well, we got our stoplight, right? So if it fits my rule, if it fits that rule, it's a green light, right? This is a green light, 25 cents, right? If it is 2 times the rule, 2 times my rule, we're looking at a yellow light. And if it's 3 times the rule, it's a red light. That means, if it's a $250 stock and these are 75 cents wide, listen, don't trade options around them is really all I can say, because you're going to have to give up so much edge to get in and so much edge to get out, especially on something like the iron butterfly, that you're going to get eaten up on giving up too much edge on either side. And it's going to make it a lot more difficult for us to get out of this strategy as well, because we're going to have to give up that massive edge to get out. So in that time, we're really fighting a massive uphill battle in our own price discovery. If they're 75 cents wide for a $250 stock, another thing is there's probably only one guy making the market, and he's not going to give up the edge for you. Think about it like if you're at a farmer's market. I used that example last time, and I've tried to come up with a different one, but I think it's one of the best ones. You're at a farmer's market, one guy's selling apple. He probably isn't going to have a whole lot of price elasticity, right? Or at least give you price elasticity. He's going to make you pay his price. He knows he's the only guy there. If there's 5, 6, 10 guys selling apples, well, you're going to be able to talk him down, and you're going to meet in the middle somewhere. You're going to be able to adjust your prices a little bit better. Same thing in here. If the market is, full on free market price discovery, there's people that will be making better markets as soon as they see you come in to the market. All right. Because they want to get filled before somebody else does. And the way to do that is to be the one that is the best bidder offer. Right. All right. So that is what we're looking at for a good destination. What I mean is there good volume and open interest? You could click over, you could hit this button up here, do the drop down, flip over, see if there's volume and open interest in there. Yes, but I'm trying to streamline your process here. This is an easy way to look at it. It doesn't take a lot of thinking. $1,000 stock, it's $1 wide, right? 3 ticks to the left, it's $1 wide. That should be fitting that rule. And I'm speaking specifically to the people that are newer options traders. If you are trading in something like Aon all the time, it doesn't usually fit my rule. It's more of a yellow light, and you're an experienced options trader and are willing to, cancel replace until you get filled, then that's a different story. And that's something I implore anybody to do, not go straight to the market. Don't lift an offer. Don't smack a bid. Don't just go mid-market. Incrementally increase your bids or offers to get filled, all right? It costs you nothing to cancel replays. So make sure you go through that whole price discovery. There's algorithms out there making different markets constantly changing. I'm not saying like put a bid or an offer in and wait 15 minutes to get hit. What I'm saying is put that in there, cancel, replace. By the time you go back, cancel, replace. That should give all of the market participants, especially the algos, an opportunity to get the best market. Yes, Thomas, I would love to use your analogy. Hilarious, but I can't. All right, so how they figure delta price moves. Price moving is increased, decreasing premiums based on delta. That is understandable. But why delta is changing when the price is changed? For example, $1.20 or 12-cent delta is 40. Wait, a 120. Are you talking about the strike? 120 strike, the delta is 40. If the price moves up to 124, the delta is also changed to 145 or 150. Okay, so, well, that's because if the price moves up by $1, you can kind of see it usually showing up. Let me pull up a platform that shows, because this is increments of $2.50, so it's a little bit wanky. Let me get up the platform real quick so I can clear this. What you're doing is you're seeing gamma get added back in. So here, I'll show you. Let me go to trade page. I still got FDX up from doing this. So let's go to something like Budweiser, because it's got 50-cent increments. Let me do something that is dollar increments. I think DAL is dollar increments. Okay, just to make it a little, and we got the high-low delta in there already ready to go. But what we're looking at here is, let's just go for a dollar move, right? So we're not getting too much in the weeds here. And let me pull this back up. All right, so what we're talking about here is going from 31.10 to 31, 31 to 32, right? So we're trading at right around 32, okay? So we've moved up $1. Now, if you look at this 31 call, just to make life easy, all right? And we moved, or let's look at this one. If we moved up by $1, all right? So now we've gone from $31 to $32, all right? What would happen is that 45 cents goes into these premiums. You can kind of see it right there, right? Where it's very close to being increasing by about that 45 cents. So what you're talking about is on that next dollar move, it's a 9-cent difference. And between these two, you can see it's an 8-cent difference. And that might be where the confusion is. In this case, what I'm thinking is this gamma number is being rounded up to 9. It's probably 0.8, 5, okay? So that's rounding it up to 9 to get that number. But you can see between the two, just $1 difference, it is a 9-cent difference. Over here, we've got, that 9-cent difference there. Now we should have about an 8-cent difference between these two, but it's showing a 7-cent difference. The idea there is it's a rounding error. So am I answering your question without trying to confuse everybody? You can kind of look at the difference here. Let me just erase all of this stuff and go back to it. Oh, is that not going to let me erase? There we go. All right, so what I'm saying here is basically, if you look at this 9 gamma, right? And we're at the 32 call. idea is when it increases by that extra dollar, you can see basically this gamma is kind of going in there. So from the 36, it increases, it went to, the 45, all right? The 8-cent gamma, kind of looking at it, it increased to that 36. That's a different representation of that, or a different way to think about it, is that gamma does go with delta, but if you want to see it visually already implied in the pricing, you kind of have to look at that on the angle there. All right. Does that make sense? And you can see that happening over here as well. So once that increase happens, this is already, if we are looking at it right now, if we are this 9-cent already, added in to the delta from when this was 30, when it was $30, it went to $31. Well, actually, this already went in there. See, kind of? That makes sense, Pa? Because it basically went from 45, and we added 9 cents in there, and yes, it is only 8 cents, but again, that could be a rounding error between those two. All right. All right. So what's the environment here? Well, we're going to pop or drop kind of idea. I need to look at the internals now. This is where we're going to start really digging into implied volatility, all right? So when we're looking at that implied volatility, we already know we've got this idea in our head on the pop or the drop, right? Or we don't know which direction FedEx is going to go. I've already looked at it. It is a good underlying to trade options around. Now I need to look at FedEx to see, look at our road trip and see if, do we have sunny roads, clear in either direction? If it's sunny, it means low volatility. There's low stress. Think of it that way. It's clear skies. You can see for miles, right? But then when there's high volatility, the outlook is pretty murky. You can't see maybe 10 feet in front of you. You're stressing, you're white knuckling it, trying to keep it in between the lines, winds are blowing, whatever. All of those things creates volatility. Volatility is stress, all right? It's pain in the market. And pain can happen on the upside or the downside. A lot of people say volatility only spikes on pullbacks. Well, I'm here to tell you, if you see big spikes to the upside, volatility will have a tendency to increase as well. Why? Because volatility is actually a product of people buying options, all right? And they start buying options for protection or fear of missing out, right, on the upside. So they're flying to buy options. They're not even paying attention to what they're paying for anymore. They're willing to pay through the nose for that insurance or that directional move. So the prices just get jacked up and usually well overinflated. The stress really is overdone. So the idea really is when volatility is super low, hey, it's going to go back up to basically middle of the road, all right? And when it's way overdone, it's going to pull back. So we need to learn to take advantage of that. We have to understand volatility around XYZ. I'm not talking VIX, you guys, because the VIX can spike and my underlying FedEx might not have any kind of volatility spike. It might be super low. So we need to really look at our underlying and understand where its volatility is, implied volatility, forward-looking volatility is in relation to where it's been in the past. Because it has a tendency to stay within, a certain range. Our volatility will have a tendency to kind of bounce back and forth like that. Underlyings, will have a tendency to channel in a certain direction as well. Volatility usually stays within a pretty good swath for that underlying. So for some of you guys that I see your question there, Sam, I'll get to it in a sec. But for you guys that really want to drill down on this, I've got a mathematical equation for you. And it's important to understand this mathematical equation, you guys, because we've had a black swan event. And sometimes we want to take out those black swan events. All right, so basically what we're looking is we take the current minus the low, and this is the current IV, implied volatility, minus the low IV, and you take that sum and divide it by the high IV minus the low IV. All right, and then what that tells us is if we have low IV percent, if it's low IV, I consider that less than, I can't erase that, less than 50, all right? And if it's high, it's going to be greater than 50. It's greater than 50, all right? So that's what we're looking at. So if this equals, above 50, then that is considered high implied volatility for that underlying. And if it's below 50, it's considered low, all right? And if you're newer to options trader, newer to options trading, or you have a lower risk tolerance, then you could say low IV is less than, I'd probably say 30 or 25, something like that, or greater than, let's say, 70, okay? So if you have a lower risk tolerance, use that, but this is my rule of thumb there. And you can easily ballpark this thing here. So why does volatility matter? Because especially if we have low volatility and it goes back to high, our premiums get jacked up. Remember, for every 1 percentage point increase, for my FedEx example, that was like, I think, what was it, 18 cents? So you get like a 10 percentage point move, which is not that big of a move, to be quite honest, in implied volatility for an underlying. Well, that 18-point move, or that 10-point move, is $1.80 in premiums. That means my underlying could barely move, and all of a sudden those premiums get jacked up. I can see myself be profitable when I bought low IV or when I had sold high IV. So the idea here is we already established volatility affects the price of an option, and I did that at the very beginning when we were looking at the internals of the Greeks. Now, if volatility is high, we want to sell premium. If volatility is low, we want to buy that premium. So it's kind of like you're buying volatility or selling volatility. That's why I'm saying it's so important to understand where it's at. All right. Hi, Eric. Is this case on the butterfly or for the basic options? Sorry, was not sure. Well, right now I'm talking about basic options. Anytime we are trading options, the idea is if we have low volatility, we're leaning towards buying a strategy. We're paying a debit. It doesn't matter if you're buying a call, buying a condor, buying a call spread, buying a diagonal, stuff like that, right? What we're thinking about, and I wouldn't be buying a diagonal necessarily, but you're paying a debit for something. Anytime you're paying a debit for something, you need to know that implied volatility for that underlying is really low, all right? So what we're doing with this roadmap is we're kind of going through the process. We got this underlying that I think is going to pop or drop, but I need to know, is it a good underlying to trade? I got my direction. Now my destination, is it a good underlying to trade? Now I'm looking at the environment. What kind of environment do we have? Well, for FedEx, I don't know yet. So is it sunny skies or is it gray skies for this? Well, what we want to do is forget about all this up here. We don't care about this stuff for volatility, right? We've already come up with our assumption on directionality based on the charts, right? So what I'm looking at is down here, and I've got a chart of it, right? Implied volatility. I want to know where this number is in relation to the high and the low. You can see they have a tendency to stay within a pretty good range. Now, this is the black swan event I'm talking about. The last time we saw a spike like this in all these stocks across the board and in probably even the VIX, is 1984. Before that, 1929. Those are those two extreme types of spikes. We didn't even see it in 2009, all right? Yes, we did see a massive spike in 2009, but not quite to the amount of move that we've seen here, okay? So, you know, one thing we could do when I was talking about this is look at this, let's drill down on this. Let me get rid of that a little bit. I'll pull it out of the way. So this is the same implied volatility chart that we looked at over there in the previous slide. I just blew it up. All right, so, and I see your question there, Thomas. Give me 1 second here. And Sam, did I answer your question there? So, you know, that one equation I was saying, you know, we're going to take the current IV minus the low IV, right? Take that sum, can everybody see that? Divided by the high IV minus the low IV. And this is for people that really want to drill down, like to know the real details. I'm going to show you the streamline here in a second. So basically what I have script and put over there in the watch list and stuff like that, because this is the thing that is the determining factor for me on implementing an option strategy, okay? Whether or not I'm buying, whether or not I'm selling, it is the most important thing to understand, that you have to understand this. So 40 for FedEx is looking like it's pretty low, right? I mean, for the guys that want to streamline this process, you know, you can see that within the range, this is pretty low. And we need to know this because the premiums are determined, are telling us how expensive or how cheap they are. This is the way to tell if your option premiums are cheap or expensive, right? Everything else is just a normal move. Delta doesn't really change other than on the $2 move. Yeah, gamma goes in there, but those are pretty constants, right? And this is the thing that at any given time can affect our premiums. So we need to know if we're buying them cheap, because then we know it's probably not going to get much cheaper than this, right? It's like then we know they're on sale. But, you know, when the new line of clothes comes out, that's when volatility is high, and we know that those prices are the new fall clothes, or they're probably doing spring already, who knows. But anyway, when that new line of clothes comes out, you're not getting anything on sale, all right? So, and, you know, the script is going to show this is the high, that is the low, and it's only basically for 52 weeks. And what is this in relationship? So if people want to really drill down on the devil of the details, what we would look at is this, and I kind of covered it up. It's right around 1, and it's going to be in decimal places, right? I'm just going to make this all, I'm moving the decimal out on all of them to make it equivalent. So the high is about 140. The low is right around 17. All right. We're going to take, oh, sorry, I already messed that up. I got ahead of myself. The current is 40, but we know that this is 140. This is what I wanted to do. This is 17. This is 40. Those are the numbers we need. So the current is 40 minus the low, which is 17. We take that number and divide it by the high, which is 140, minus the low, which is, minus the low, which is 17. So basically, the idea is we're just finding out where 40 is in relation to this number and this number, okay? So if we put that into a calculator, it's going to pop out at around 11.42, all right? So it's telling us, and that's in percentage points, all right? Making that a percent. So it's about the 11th, 40 is in the 11th percentile between there, okay? That's what that's telling us, you know. And further, you know, with me, I want to look at the, I'm going to do something different here. For me, I want to take out that black swan event, right? So I want I want to take this part of the equation out. All right. Because I think it's more or less going to be something like, maybe I don't think that we're going to see those massive spikes that we saw, but I do believe volatility is probably here for at least the rest of this year. So if I'm thinking that volatility is going to remain relatively elevated until maybe even into 2021, based on everything that's going on, I do believe volatility is going to remain relatively high, because you can see last year these highs weren't even up into the 40s, to be quite honest. So I think that, it's kind of out of this is kind of out also. So I want to kind of look from here going forward. So, if you wanted to really dig into the devil of the details here, you could be looking at, and my line's not very good, but you could say that, 78 is the high there. The low here is going to be 35, the way I drew it, 35, 36. So you could punch in all of those things, the high, the current minus the low, 40 minus the 35, and the 78 minus the low 35, right? And come up with your percentages that way. But you can also just kind of do this with ballpark. You can eyeball it, say this is probably right around 50, somewhere in there. That wasn't I should have used my straight line, but you guys get the drift, right? Somewhere in between, the middle is where it wants to migrate to. You can see when it rallied up here, it traded right through there, right? It's going to have a tendency to come back extremes, hit the lows. You get that volatility crush coming out. Like I said before, that I didn't want to erase all of that, but I may just do that. Volatility has a tendency to creep up and then crush out, creeps up and crushes out. Here it's spiked, but you get those spikes back and forth. And that's why we want to, this is where you would be buying, right? And this is where you would be selling, right? You buy low, sell high. 18.7% calculating. Am I calculating wrong? Maybe not. I may have calculated that wrong. Was that from the 141 on this? You know what? I used 149 in my example. I tried to pull it up. All right, so it's 18.7. Sorry. So this, on this one here, 18.7. Sorry about that. See, I used 149 in my example that I was, when I did it, so I didn't have to punch it into the calculator. Thank you very much, William. So 18.7. I can't erase that. So 18.70-ish. Thank you. So yeah, so still less than, so it's still meeting that rule, right? So we have less than an IV of 50, right? And even for somebody that has a lower risk tolerance, it's even better at less than, we could say, you could even say that less than, if you have the yellow light, it is less than, and the green light is less than, 30, which is what we've got, right? So we've got a total green light on low volatility, right? We've got that super low volatility. What's that leaning towards? That we have a situation where we are low volatility, all right? So what's the duration that we're going to be looking at? Well, I talked about this. Theta is the thief in the night. That's the duration. Thief in the night really gets aggressive near to the expiration. So we want to get out in time. So when I'm talking about this, the duration, I want to be outside of 70 days to expiration. All right? I'm leaning towards, when I got low volatility, that means I'm leaning towards buying. We've already established that, right? We've established that theta, the thief in the night, is aggressive inside of 35 days to expiration. That's where it really starts picking up. Outside of 70 days is kind of the sweet spot. We aren't going out 200 days. I'm only going to keep this strategy on for probably a few weeks anyway. So I'm just trying to limit the theta decay during that time. And the difference between 70 days and going 180 days, the theta component isn't but a couple of pennies difference a day. All right. And that's not something I'm going to be too concerned about with this strategy. So I'd much rather pay less on this strategy and have that less risk, because I'm paying a debit. That's my risk, right? All right. So when we're doing this, when we want to buy an option, we want to limit that theta decay. That's why I'm looking out there in time. And this is where I was talking about. Inside of 35 days to expiration, you can see this theta component really fall out of bed, right? And out here where I'm talking about, that theta slope is a little bit less, right? We can see that it kind of falls off. Now, something to note here, we talked about volatility. When volatility goes up, well, we'll see these premiums kind of hold off that theta decay. So that's something we want to take advantage of also, right? So we want to limit theta. We want to limit the thief in the night out here. But something to keep in mind, we talked about volatility affects those further duration options more. So when we're buying cheap, well, hopefully we can get that volatility start to expand, and that will help us. As those premiums increase from volatility, hopefully, then that's going to hold off theta and hopefully get us to a winner rather quickly. And I know I'm talking a lot today. I'm sorry, you guys. What percentage is it a buy or sell? 18.7. What are your boundary rules for the buy or sell? I think I might answer that, Gerald. Did you get that? Where was that slide? It was way back, I think. This one? Days direct, limit theta decay. No, sorry. All right, I'll just do it real quick. Theta decay, I'm just going to do it on this one. So this is back to, actually, let me find the right slide. I think it was it this one? All right, here we go. So basically, I'll just do it on this one. Actually, I'll leave it on there. So if this number, which is 18.7, right? At 18.7, that we come up with. But my rule is if this number here is, and our answer is it's greater than 50. Actually, let me do this because I want to be able to change the colors. If it's greater than 50, all right, it's kind of that means you're selling. All right. If it's greater than 70, more of a green light, you're still selling, right? Anything above 50, you're selling, all right? And if it is less than 50, we're going to be looking to buy, all right? And even better, if it's less than 30, that's a green light buy, all right? It's right there at 50. It's really hard, but basically the idea is you're just trying to catch volatility on the upswing when you're buying, and you want to catch volatility on the downswing when you're selling. So for instance, when it gets up to these levels, those are areas where we want to be selling premium and areas where we want to be buying premium. That answer that? So in this case, we have a green light. We have a green light buy on the 18 70. People are probably like, dude, you are getting way too pen happy. Cool. All right. All right. So when we're buying options, trader wants to limit the theta decay. I got to go further here. We talked about the days to expiration. This is when we have low volatility. We want to get out there in time and limit that theta decay. So what vehicle are we going to use? We're going to do the long iron butterfly. Well, what's the difference between the long iron butterfly and the long straddle that we did last week? Well, in this case, I kind of want to limit. Maybe you have limited money you want to allocate towards this strategy because you just aren't too sure about it. Maybe you want higher probabilities of success, which this will do. Because think about it. If we're just buying the straddle, well, our premiums are that of the straddle. But now if we sell out of the money call and an out of the money put, yes, we are limiting some of our upside and our downside, but we're also bringing in our break even. Because if you remember, a break even on the straddle is the call plus the debit is the break even, or the put minus the debit, the total debit, is our break even. Now, if we can lower that debit, which we will by selling a call and a put, well, then we are increasing our probabilities of success by getting past that break even. And that's at expiration also, you guys. I don't plan on holding this into expiration. All right. What would be looking for day one iron butterfly for a 1 day iron butterfly? I do a lot of SPX. Would you look to leg out? So, Thomas, when I was on the floor, I was a legging guru, for lack of a better. That's how I made my money, was basically legging in and out of spreads. All right. This day and age, I have found that legging in and out of spreads, yes, you can do it for winners, but it seems to me like 50% of the time you're going to leg out of it well, 50% of the time you're going to leg out of it bad. And when you leg out of it bad, it's a lot more painful than when you legged out of it better. Like you're going to lose a lot more money when you leg out of it bad than when you've legged out of it good. It's just, and it's a psychological thing too. Like you will have a tendency when you're trying to leg out of it and it starts going bad to let it get worse for you. You just can't do it quickly enough. And when you get out of it, leg out of it good, you're so happy you like, oh my God, you're just taking a couple extra pennies. So to me, in this day and age, online trading, it does not pay to leg out of it. Now, we did do the iron condor not too long ago, and I have some mechanical adjustments for that type of trade where, especially on the short side, how you can mechanically adjust your prices to be mechanical and lower some of your risk tolerances, which I haven't gotten to I don't think I've done the short iron butterfly or iron condor to adjust that, but that should be coming up shortly. So check out that one though for that. But I usually do not leg out of it. And I usually don't do like 1 day, try to play for a 1 day strategy. And I don't mind that, but I'm usually looking for a longer duration, but not really long. I mean, a couple of weeks. If it happens, I'm more than happy to. I hope you're not using like weeklies for that 1 day long iron butterfly though. Still go out in time and limit that theta decay, even if it's like 1 day, because if it doesn't work out, you're fighting an up. If it doesn't happen immediately, then you might be fighting an uphill battle there. All right. So what spots did we visit? Well, what I'm talking about here is what's our strikes. Well, we talked about with the straddle. Obviously, we're still using the same strike location. I don't know why this is I should have changed that. This is the at the money, 50 delta. All right. the at the money 50 delta. I'm sure I didn't change it on the next slide either. 50 delta. And then on this one, you know, that's what you're basically going to find online, is they're not going to tell you where the short call is or the short put. But we're just trying to sell, you know, when we did this straddle, we're just trying to sell this call and this put in order to lower our overall premium that we paid for it. So when we're doing this, we're basically looking at the monies here. Sorry, I put that in incorrectly. And this should be 20-ish, right? Ish. All right. And it's not always going to be exactly the 50 delta. It could be 51 deltas, 49 deltas, that stuff. So obviously that's the issue. As long as we're using the same at the money or very close to at the money strikes, they're the same. These two are the same strikes. But more importantly, what I want you to take away from this is when we build this strategy out, you might be asking, I need to know a little bit more. 20-ish is a little bit vague. Try and streamline your process. Another thing you can look at is whatever you pay for the straddle, right? You build this, I do anyway. I don't go and do a butterfly tab for this, you guys, okay? I like my strikes. I don't like the strikes that they give, and it's more of a hassle for me to go back and change it. I usually go in on my computer, at least tosses this way, where I hold down the control button and I just add in all the legs, okay? I hit both the call and the put, holding the control button down, and add those legs in. It's a lot easier, at least in my eyes, to get my thing here. So whatever, this is a symbol for the straddle, is whatever you pay for the straddle equals, you know, whatever you pay for it. That's the idea of where you want to look at the width of your spread from the call and the put. So for instance, with mine, let me see, I can't get over here. Let's take a look at an example of it. This is the FedEx one, right? We're still looking at FedEx. You can see here, I've moved on. I don't have that December contract for this, so I went a little bit further out. The November, this is pretty close to that 35 days to expiration. And with the butterflies, you guys, it takes a long time for these things to work out, even if they start making those moves. You got to be patient with this strategy. So what I did is I started out with this one, or the 260s, right? So I started out here. You can see they're the 50 deltas, right? So if we look at these two strikes, when I add those two together, it adds up to about $46. So in my head, you know, I'm thinking it's got to at least be $40 wide. All right. That's what, you know, to streamline your process when you're building it out. I looked at the straddle. It's about 46. I know I can't go 50. It's probably going to be too wide for me for my risk reward. So I'm looking at, and we could look at it a little bit more detail and look at that further out when I pull up the platform. But what I want you to look at here is I basically was looking at $46 when I built out the straddle. So I knew I needed to be about $40 wide. So that's why I picked those strikes, right? Now, drill down on it a little bit further here for those strike locations. What I want for the risk reward on this is if it is basically your risk is 3 to make 1, then that's basically a green light. Sorry, probably should pull up my other thing, which is in line with this. It's $40 wide. I'm risking 3 to make 1, right? If it is risk 4 to make 1, then you're looking at like a yellow light. If it's risking 5 to make 1, then that's the red light. All right. So I guess I can pull that thing up again and do that, but I'm running a little bit long. I'm getting really talkative. So you get that green light, risk 3 to make 1, Yellow light, risk 4 to make 1. Red light, 5 to make 1. So as you're getting those legs wider and wider and you're testing it out, you're going to basically say, I got a little bit wider. I'm starting to get into more of a yellow light area on the really wide ones. All right. So you guys got this. We already talked about this direction. If you have a direction where you don't really know where it's going to go, but you think it's going to pop or drop, you've got that. The destination, that's that less than or equal to 10 cents rule, right? Or move it 3 there rule. The other thing is the environment. We buy when it's less than 50 IV%, all right? And or, we sell when it's above. But in this case, we got it below. The duration, we want to limit theta decay. Days to expiration is greater than 70 is basically what I'm looking at. And the strikes, we want 3 to make 1. All right, so we're picking those at the monies, and then a streamlined way to look at it really is, what's this debit I'm paying, all right, on the straddle? That's how far my width of my spread is. That's a quick way to streamline that, all right? You can't go usually further out. Like in my case, I couldn't go out to 50 because it's probably going to start being more of a yellow light. I don't mind if you do that. Just know your probabilities have gotten a little worse for you on being a winner, all right? So pretty simple here. Max profit is the width of the spread minus the debit. So I mentioned that, right? I was paying about $30. I was paying $29 to make 11. All right, that was my max profit is $11 on that. I'm not ever going for that max profit. I'm going to talk about that here in a minute. Max loss is the premium pay, and I mentioned this. It's still basically the long call plus the premium, or the long put minus the premium. It's the same as what we talked about earlier. All right, so we've got FDX, and we're taking the iron butterfly, right? On a winner, you guys, I am looking to take about 50% of max profit on that. Or, if you have a higher risk tolerance, I would say, an increase in my premium by, 25% is about the same thing. You want to probably go for closer to 50% max profit is the easiest one. So in my case, on that $10, I'm looking to get $5 out of it, somewhere between $5 and $7 out of that trade. Why? Because like I said, these butterflies in general, just, and they're not my favorite strategy, and I'm not going to lie. I do like putting them on every once in a while when I've got a real, you have to have that big move happen rather quickly for this to work itself out. Another thing to do is the winner is when it hits, dyslexia, hits my short strikes is really ultimately my rule of thumb with this one. You can look at it for increase in, if it goes and hits those short strike, that short call that I define the risk, or the short put, I'm looking to pull the ripcord on it. Why? Remember I talked about delta is data? Well, in this case, what I'm looking at on this option strategy is these are 25 delta and a 24 delta, right? So my probabilities of being in the money at expiration is 25%. That's what delta tells us also. It's not just Justin. That's why I said it was data. But on the floor, we used to say two times the delta is equals the probability of getting kissed, right? Or 2 times the probability of getting touched, meaning the underlying comes up and hits that strike, all right? 25% chance of being in the money by 1 penny at expiration, or a 50% probability of coming up there and hitting my strike. I'm taking the probability of hitting my strike. Therefore, that comes up, hits my short strike. I'm pulling the ripcord on this strategy for whatever I can get for it. I know I'm profitable. It may be right, and it's likely to be right around 50% of max profit. If it happens in the next day, sometimes that's not going to work out as being 50% of max profit, but I know I'm profitable. I know I crushed the probabilities. I'm willing to walk away once I beat the probabilities on any strategy, okay? And for a loss, you know, because it's such a steep loss on this one, you know, I would say, you know, get out at probably a 30% decline in my debit, right? I am most likely, you know, high risk tolerant guys, 50% reduction in debit. Lower risk tolerance, high risk tolerance, okay? I'm not going to let this thing work itself out to zero. This is another way to look at it, is your expiration. If you're in it less than 10 days and you've got a 10% of that max profit, you might be thinking, you know, obviously with, you know, stocks that are less than $50, you can't necessarily do this, but on stocks that are above $50, especially in the multi-$100 stocks, then this definitely works out. So you can kind of think about that. All right. So this is of max profit. All right. You can look at it that way. So there's several different ways to look at it. Find something that you like. For instance, I like it hits the short strikes, I'm out. All right. I get a 50% reduction in the premium paid, I'm out. You know, if it just, I have a friend that has a time stop on it. If it doesn't start moving in 5 days when I thought it was, basically, you know, he's looking at chart setups and stuff like that. If it doesn't start moving based on a chart setup, then he's out, right? After 5 days, he's not gonna risk it anymore. So you can do it that way as well. But for me, I'm looking at it hits my short strikes. That's my favorite. Hits my short strikes. Usually when I'm going into the strategy, I implore you guys to do the same as what I was talking about with something like this, where you write it down. I know where I'm exiting. Like I put it down on paper. When it hits my short strikes, I'm out. And if I get a 50% reduction in the debit, I'm out. Okay. So I've got that on paper. That will keep you guys staying mechanical. All right. We want to take the emotion out of this. We don't want to think about this as money, right? That's why I'm saying, you know, I like this one, the short strike, because I'm not thinking about the money. I'm not thinking about how much money I've made. I want to take that emotional aspect out of it, or a 50% reduction in debit. You know, that's not really an emotional attachment that way. And I write that down because then when it happens, I hold myself accountable. And as a matter of fact, just recently somebody reached out to me and was like, you know, why do you do this if you're a trader and stuff like that? Why do you take the time out of your day to teach people how to trade? You know why? Ultimately, it makes better markets, for one. Two, most importantly, though, you guys keep me staying mechanical. You guys, I look at you guys as you guys are keeping me in line with my rules. I don't break the rules, right? I know that if I break my rules, that it will negatively affect you guys down the road. So that's why I stick to mine. And you guys hold me accountable in a sense, all right? Or at least I feel that way. I'm accountable to you guys. And that makes me a better, you guys make me a better trader, is really, you know, more than anything, what I found after doing this is that you guys are making me a better trader. I'm staying more mechanical because, you know, I'm practicing what I preach better. Yeah, I've come up with these rules before, a long time ago, before I started doing these things. On the floor, we usually had like a mentor or something like that that would hold us a little bit more accountable. But you guys, you know, I love you guys for that. You guys may not know that that's what you do for me, but you do. You guys make me a better trader. Are these good, like 30 days to earnings? Because IV usually, and great question, Thomas. Yes, going, and one of the things why I picked FedEx over the Disney trade, which is the one I really wanted, is the earnings for Disney were a little bit too close. I wouldn't have had enough time for this strategy to really work out. But yes, definitely, if you're heading into an earnings, this is a good strategy for that, because, you know, that volatility heading into the earnings, what Thomas is really referring to here, that volatility increasing heading into earnings is really easily going to offset that theta component ripping into you, right? So yes, heading into it. A caveat though, any debit spread heading into an earnings, I like to cover before that earnings. Why? Because of the volatility crush coming out. After the binary events have a tendency to make volatility increase. And after that binary event, we see that volatility just, because there's no more fear, right? We know what is going on. So the volatility as a component of that really falls out of bed. So I don't like to hold these strategies through it. You might be directionally right when you're buying a strategy going into that earnings event, and after that event, it really hurts you. I would rather do something different if I wanted to specifically play that earnings event, right? Plus, going into that earnings event, it's all unknown, so I might as well play the unknown earnings event that day of the earnings event, right? There's nothing getting revealed before that. You're kind of playing a hunch, and I'd like to play play that volatility expansion heading into it, cut myself off right before it, and if you still believe that it's going to do something, you have a directional assumption for that earnings event, there's higher probability strategies to implement around that specific event. Does that make sense, Thomas? But good question and timely, because with my offer today, you guys, $36. I know you guys have questions about trading earnings. They're the most fun for me. I love trading earnings. You guys watch the daily market commentaries anytime earnings seasons comes out. I'm like doing this, right? Because you're in and out of strategies. I would much rather be in and out of strategies than dealing with like my Coca-Cola trade that I still have on from the last earnings, right? Yes, I'm staying mechanical, lowering overall cost basis on that. I talk about how to do that all the time also. I'm talking about winners, losers, and draws, you guys, in my daily market commentary. So you guys should really, if you guys enjoy how I teach, I'm talking about the data and all of that stuff in those daily market commentaries on a daily basis, all the trades that I have on in my portfolio. And how when these trades go against us, what do? I talk about that more importantly than anything else. And that happens to all of us. I don't care if I'm not that guy that cherry picks you guys trades that are winning for me. I'm the guy that's talking probably about the losers more than the winners on a daily basis, because those are the ones we have to turn the tables and become a winner on. So, for $36, you guys can't beat this. This is setups heading into the earnings, kind of like what we were talking about there, Thomas. I have trades that, if we are looking out in time at some strategies for an underlying, we're playing for that earnings. I've got those trades. Also, how to protect your portfolio is in this for earnings. And then I actually set up trades for that earnings, and this is for the next earnings season. So if you got something down the road, like what we were talking about, Thomas, that's where I meant, is 45 days, 30 days down the road, there's an earnings coming out. How do we take advantage of that expansion of volatility? Well, that's there. If we want to do earnings trades for that earnings, I talk about strike location and all that stuff here. And why you shouldn't be doing what these guys on TV, on mainstream media, some of them my friends, make for their earnings calls, like let's the day before earnings go out and buy a call for something that we're bullish in. I disagree with that wholeheartedly. I can guarantee you that this $36 is going to save you a lot of heartache by clicking on the chat window. Yes, thank you. Somebody's like, in the chat window over there or over there, wherever you got me looking, is the hot link for this. Is the hot link for this. All right. Here is also the link down here at the bottom. And so you can punch that in your URL if you're watching this on tape delay, like you weren't able to make the session. We're sending this out. So you guys will get that offer for today. Otherwise, this is probably one of the last weeks that we're going to be offering this for you guys. What was I going to say? There's a bunch more in there, but 10 plus hours probably specifically talking about earnings trades. And, stick with me on the daily market commentaries. You can follow us on Facebook, follow us on YouTube. We're putting a lot of content out there. So protraderstrategies.com on Facebook, you can do that. Because like I said, I don't cherry pick trades. I literally, in these daily market commentaries, go through the daily economic data, geopolitical stuff that's going on, like the FOMC, see how that's impacting the overall markets, giving you guys my market assumptions, talk about specific trades I find. I'm not trying to solicit you guys to do any of those trades, but what I'm trying to do is give you what I go through my process. This is why I came up with all of this stuff, and this is why the disclaimer is important. I'm not here to give you guys trade recommendations. I've never believed in that. I think that your guys' directional assumptions are as good as mine. But I do know that from working on the floor, when is a good time to get into a trade and when is the time you don't? Because we didn't have the choice. We had to make markets. And we used to say when we got into a bad trade, it was because they were stuffing us with trades that we did not want. And that made me a better trader in a sense, because I knew I had to quickly become mechanical and start, like we were talking about, legging out of spreads. That's when I needed to leg out of some things or put on some hedge another way that was a higher probability strategy for the strategy I just got stuffed with, right? So what I'm trying to do here is teach you guys how to avoid the pitfalls of trading. As a floor trader, we couldn't avoid those pitfalls all the time. So you guys, please take advantage of that link over there if you like what I've done. One of the best things you guys can do out there for me, is if you like what I've done, share it with a friend. Let them know what we're doing over here at Pro Trader Strategies, because at the end of the day, they don't have the same market assumptions as you. And if they learn, more and more people learn how to actually trade these markets, we'll become tighter. We'll have more volume and open interest in Aeon, right? Because there's going to be people that are interested in trading Aeon, and those markets will become tighter. It opens the world of all of these underlyings that nobody is trading to allow us to trade, So it makes better free market price discovery the more people that are trading options. So you can kind of think of it as a selfish way for you. No, they're not competing with you, but ultimately we're all better traders. It comes down to implementing strategies the right way, okay? So that's all for my soapbox. Like I said, the link is over there in the window. Thank you guys all for participating. Any questions, comments, or anything else like that, reach out to us. Right here's our phone number, or at trading@protraderstrategies.com, all right? So take advantage of it. Like I said, share this with your friends. Let them know about Facebook, protraderstrategies.com, and our YouTube channel. All right. That's all I got for you. If you got your camera up, this is for you guys. If you can't take that, take it easy. Take care, Alexander. Thanks, Stephen. Appreciate it. Thanks, Thomas. Bye for now.